And this is Tyler from MacroOps presenting this week's Market SitRep entitled Buying Sprees. So we're going to get into three things today. We're going to talk about the ECB corporate bond buying spree. Then we're going to look into some Belgian equities, a little bit interesting there. And then we're going to finish off with a bad news is good news discussion. So in the ECB buying spree that occurred this week, first off, I want to begin with a Mario Draghi quote. Pretty interesting. And I quote, "Our task is not to maximize the chances of price stability under the constraint of not creating side effects. There are always side effects to monetary policy, and we are not at liberty to choose to fail our mandate." So basically what Draghi's saying is this man does not screw around. He's willing to go all in despite any type of long-term side effects, because he's basically saying as long as I go into the office, I'm going to do whatever it takes in my power to keep the markets propped up. So something just to be aware of. This guy is not screwing around, and he also doesn't really care about any long-term side effects that negative interest rates or extreme QE could have. And why does he have this mindset? Well, it's actually pretty simple when you look at the conditions over there. And if you take it unemployment at 10.2% now, it's still very, very high. It's only come off a couple percentage points from the high in June of 2013 at 12. So he needs to get this trend much, much lower and accelerating down in order for the Eurozone, to keep stabilized. I mean, there's a lot of problems that you get when you sit at 10% unemployment for a long time. So he just wants to do whatever he possibly can in his power to press that number down. So in March of this year, ECB decided to increase those asset purchases from 60 billion euros a month to 80 billion euros a month. And the reason why we're talking about it this week is because they added corporate bond buying into this program, and that started on June 8th. So the ECB has said that they will buy investment-grade bonds from companies incorporated in the Eurozone except from banks. So Draghi and the ECB, in an attempt to basically more easily transfer the stimulus to the real economy, is using corporate debt outright. They're not buying a bunch of securities, government securities, or lowering rates and trying to transmit the monetary policy through the banking system. Instead, they're going right to the source and relieving debt from actual corporations. And they've allowed themselves to buy up to 70% of a corporate issue. And of the 80 billion, most analysts think that 5 to 10 billion will go to these corporate bonds. This is definitely some interesting tactics we're seeing here, and we'll have to see how it all pans out. And so far, the market has been responding to this corporate bond buying. You can see the corporate borrowing costs are tumbling below 1% as ECB purchases begin. So here's where it made that new low. And who knows how low corporate debt goes in the Eurozone. I mean, we're below 1% now. Can that reach zero? And also, will these effects pan over to the real economy and the equity market and really create somewhat of a stimulative effect to get them out of their post-crisis lull? And you can also see here German 10-year yields reacting as well and going to all-time lows. So it's just a moment of time now before we get the German 10-year below 0% into the negative territory. And again, these are all very experimental points in time. No one really knows what happens long-term when you have all this debt sitting at negative yields. So on June 8th, they bought big. The bond that rallied the hardest was Anheuser-Busch InBev, the 2028 bond that they issued. The yields opened at 1.4, and by the end of the day, they fell to 1.3. So that bond had the largest rally on that day. But there's risks involved, obviously, and you get more vocal people coming out, obviously outside of the ECB, who are saying that because of all this buying, it distorts the corporate bond market and it becomes so illiquid that the securities are not tradable. And then you have a bunch of problems when people need to get out. You have a liquidity crunch, and then another 2008 scenario where there's just no bids for some of these more illiquid corporate issues. But as we heard Draghi said in the beginning, side effects are not a concern of his. Okay, now we're going to transition into Belgian equities, and you'll see in a second why we're going to be talking about them. But here's a chart of EWK. So it's had a nice breakout so far after this corporate bond buying program has started to be implemented, but since the initial up move, it looks like it's coming back under and going to be failing this up move. So the efficacy of the bond buying is still in question. We're not really sure if this is going to take EWK or take any type of European equities and make a substantial move uptrend out of them. And right now, although we tried to hit it for a little bit of upside, the move is not looking like it's going to play out. So under the hood of EWK, and look what you see as the largest holding at 22%. That's right, ABI Anheuser-Busch. And that was one of the bonds that rallied the hardest after Draghi started buying corporate bonds. So it's to no surprise that EWK has seen the largest tailwind from this program thus far. And just for a refresh for anyone, Anheuser-Busch, it's a multinational Belgian, Brazilian beverage and brewing company headquartered in Belgium. And a lot of people think it's an American company because they're familiar with American beers such as Budweiser, but it's actually not. They sold out to Belgian and Brazilian beverage conglomerate. So it's the world's largest brewer and has a 25% global market share. When I look at EWK, it brings me back to this pushing on a string scenario because the breakout just looks weak. And we've talked about in earlier sit reps how monetary policy is losing its efficacy because it's pushing on a string. It's like a drug. The first time you take a painkiller, it really helps the pain, and then you keep taking them, and then you build a tolerance, and you need 2, and then you need 3, and then you need 4, and all of a sudden, each incremental painkiller is not really easing any more pain. You've hit a point of no return on the medicine. So further efforts from the ECB are not appearing to be working, and Draghi also has come out since that corporate bond buying program and said at this point, Europe is going to need to structurally reform. And what he means by that is there's going to need to be changes at the government level in terms of compliance and regulation and structuring how a European worker is marketable to the global economy and really getting down to the root of some of these causes of why Europe's workforce is just not as competitive as the rest of the world. And just to kind of prove the point here on the monetary policy having adverse side effects with very little marginal benefit is Deutsche Bank is looking pretty sick. Okay, and since 2016, it's kind of held its own, but this is not a good price action setup. It's a descending triangle. These typically lead to some pretty brutal downside breakdowns once it gets under the lows of the year. So we're watching Deutsche Bank. This thing is looking horrible. And a break to the downside could easily create a semi-banking crisis for Deutsche Bank, and who knows how that carries over to the rest of the system over there. So they're really kind of pushing the gas pedal here with a lot of risk. And now we're going to transfer to the bad news is good news. And this has been happening for quite a while. It's because of this Fed backstop that everyone keeps thinking about in the market. And they really say, you know what, fundamentals don't matter as much as the Fed's actions. So that's why we have this bad news is good news. And here's the reaction function. Bad news comes out. And instead of attributing that bad news to a worsening economy, instead the market says, oh, the bad news came out, the Fed's going to back off the tightening, and because they're going to back off the tightening, there's going to be easier monetary conditions, and then assets are going to rally and dollars are going to weaken. So that's what happens. All the assets get bid up, the dollar gets sold, and that's the current reaction function we're dealing with right now. So when the market came out, or when the report came out with 38,000 jobs, the market expected 159,000. So that's way below what the market expected, and this immediately moved markets, but not in the way that you would think of from the data. It's because of that reaction function. So bonds rallied very, very hard. We've been pretty convicted on the long bond trade since the beginning of the year, and you can see it's performed quite nicely since then. And the reason why bonds rally is because when people see bad news, they say, oh, the Fed's going to continue to hold rates low, and that is an upward pressure on bond prices. Same thing with gold. When the Fed's going to expected to continue to ease and stimulate, gold gets bid up because the dollar weakens, and people think that the more stimulus the central bank puts out, the more downward pressure it's going to be on the dollar. Same thing with silver too. You guys see a huge rally off from that prior breakout period, and it's rallying for the same reasons as gold. And then finally, the dollar index weakened a lot since that jobs number. And in the context of the reaction function, it makes sense. If the Fed is going to not tighten and keep easy conditions going, that's not conducive to a strong dollar. We'd like to see stronger or higher interest rates for the dollar to rally more. And here's a pretty cool CME Group Fed Watch tool. And check it out on your own time. It updates every single day, but here's one of the more recent predictions it had. And this is based off the Fed Fund futures market. And you can see here, last month we had an 85% probability. That's taking into account what the Fed futures were pricing in, and now it's down to 96 or up to 96.3. So the market really doesn't think the Fed's going to raise in the summer, and because of that jobs report coming out pretty bad, some of the rhetoric coming out from Yellen into the meeting, so no one's really projecting that a hike's going to happen, and so that's the narrative we're dealing with. And until this reaction function central bank backstop narrative changes, assets are continuing to stay propped. We're going to need, for downside to play out, we're either going to need the Fed to continue to lift off and surprise the markets with a hike despite bad data, or have such an extreme negative catalyst come out from, say, China or maybe a banking crisis in Europe that could spill over into U.S. markets. And this is the last thing I want to point out. You can see high yield spreads have come down a lot since the beginning of the year, mainly in the energy space as oil has rallied. And the big question here is, do these continue tapering down to a more normal level, or is this just a pullback and a broader trend up? And this is very important because as credit spreads and high yield spreads widen, the market tends to do much worse. So if you're seeing credit spreads, it's a very predictive tell of where equities are going. If the spreads are widening, equities are in for some volatility and for some downside. But if they continue to tighten here and downtrend, then that is better for equity. So keep your eye on junk debt and the HYG and JNK ETFs. It's very important to keep an eye on those as a cue for where equity markets are going. Thanks a lot for listening to this presentation. You can follow us on StockTwits, Facebook, or Twitter. If you're watching this on YouTube, we'll put the links into the description down below, or visit our site at macroops.com, macro-ops.com. We give away free research every week, and good luck out there in the markets.